Good morning and happy Friday. It's Friday, the 21st of February. It's the morning blast for myself, Mr. Michael Brown. Before we go any further, let's get the legals out the way. Nothing discussed in this space session constitutes trading or investment advice or infers any kind of endorsement by PIQ Global Limited, Trainers PIQ or PIQ Suite, or indeed the hosts, which, as you know by now, is the amazing Mr. Michael Brown and myself, Mr. Ryan Paisley. How are you?
Very good morning, Ryan. Good morning, everyone. Happy Friday. You sound very chipper this morning, my friend.
Yeah, you're surprised about that, aren't you? Because you
I
thought I
am
was going to get
very
absolutely
surprised.
plugged in. No,
Well,
I even made the train home.
oh, blimey, you've made it back to the coast as well. Christ, you
Yeah,
did do well.
I know. New man, new me.
Well, I wouldn't go that far, mate.
Well, yeah, okay, fair point. Moving swiftly on.
Indeed. Now that your CFO's joined, should we do
Yeah,
something serious?
yeah, but yeah, be better. Buy your beds.
Oh dear. Right. Good morning, everyone. Happy Friday. It is at last the end of what has, in all honesty, been a bit of an uninspiring and dull week as markets have struggled to find a narrative to latch onto, and trading conditions have, on the whole, been relatively subdued. In all honesty, there has not been much going on, and I think yesterday very much fit that bill. We did see some marginal downside in the equity space, with the S&P 500 ending the day about 4 cents of 1% lower, although we did pair intraday losses of about 1%. The Nasdaq 100 ending yesterday down by about half of 1%. Not exactly moves that are really worth writing home about, in all honesty. And I think that very much is in keeping with the moves that we saw more broadly. Continued demand at the long end of the Treasury curve, with 10-year yields falling by about 3 basis points yesterday and another 3 basis points lower this morning, and similar decline observed in the 30-year yield. This came largely after comments from US Treasury Secretary Scott Bessent on Bloomberg TV. He said in this interview that terming out the debt is a long way off. To translate that into something resembling English, this essentially means that where Bessent has previously touted how he wants to move away from this huge amount of short-term bill issuance that the US is conducting, the move to do that is likely to take some time, and that, coupled with the Fed floating a potential pause to quantitative tightening, has provided some support to the long end over the last 24 or 36 hours. In the foreign exchange market yesterday, the dollar was broadly softer, with the dollar index down by about 0.8%, trading down to a low of 106.30 overnight, although recovering a touch of ground this morning after some grim PMI figures out of France. Other G10s gaining ground on the day yesterday, with cable up by about 0.6% and getting within 20 or so pips of the 127 figure during the Asia session, and the euro briefly trading north of 105 before being smacked lower after the aforementioned PMI figures. Gold trading broadly flat, although lingering around the prior record highs around 29.60, and WTI also pretty much unchanged on the day yesterday. In terms of other catalysts, as I said, they were relatively light, to be completely honest with you. The data docket was rather barren. Just the weekly jobless claims figures out of the States of note. Initial claims at 219,000 in the week to the 15th of February, up from a prior 213,000. Continuing claims at 1.869 million from a prior 1.850 million. Of course, the initial claims print does coincide with the February non-farm payrolls survey week. And an apology, because on yesterday's call I said that the initial claims print might reflect federal layoffs. It turns out they are actually reported with a 1 week delay. So we will have to wait until, indeed, you learn something new every day.
You do.
So we will have to wait until next week's figures for the impact of those Department of Government efficiency cuts to potentially become clear. In terms of other bits and bobs, we did hear from a few Fed speakers yesterday. Goolsbee was on the wires because it's a day with a Y in it, so why wouldn't he be? He was very much reiterating his now familiar stance that when inflation continues to come down, the Fed can deliver further rate cuts, and that if tariffs raise prices, then the Fed must think about them. I mean, you'd kind of hope that they would, to be completely honest with you. We also heard from the Atlanta Fed President Bostic. He does not vote until 2027. 7. So what he says does not really matter too much, but nonetheless, he is confident that inflation is on its way back to 2%. And St. Louis Fed President Musalem, who is a 2025 voter, he is also confident that inflation will fall back to 2% in time. Of course, he didn't say exactly what time that would be, but he also stressed that policy must remain modestly restrictive until inflation eases. All of these Fed speakers very much sticking to what is now an incredibly familiar script. And the same can also be said from the ECB speakers that we heard from yesterday, with Simkus, Storneras and McClough all noting that the disinflation progress and process remains on track, with Simkus also adding that the market expectations for 3 more cuts in 2025 are expectations that he agrees with. Last but by no means least, one for the tech-focused folk out there from yesterday via CNBC, OpenAI. They now have more than 400 million users, which may be of note, of course, also for Microsoft, given that they are a big investor in the firm. And that is pretty much it from me for now.
Thank you very much, Mr. Michael Brown. So before I crack on with the overnight news roundup provided by the awesome Zachary Eisman, just a couple of headlines that they came to light just as we were coming on air. So firstly, German machinery exports fell 5% in 2024 amid a global slump.
You're just reading that out because it's shit German data, aren't you? No one actually
That's
cares
exactly
about
why,
the
but no,
figure.
it gets better. It gets better. Wait there a second. So that's according to the VDMA warns of trade risks, and just also because it just so happened to come to print just as we went on air. French business activity plunges as the services PMI hits 17-month lows. Sorry, I shouldn't be laughing as I say
they've
it. But
surrendered, haven't they? Again.
Way sad trombone noises. Where are we? But anyway, back to the overnight news roundup. Japan's consumer inflation picked up further in January because of higher energy and food costs, likely adding fuel to speculation that an interest rate hike is coming soon. Japanese officials and executives say China's escalation of export controls on semiconductor raw materials, particularly gallium, is threatening global electronic supply chains. Japanese suppliers for Western giants such as Tesla, Broadcom, and Apple may need to gain export licenses from Beijing. Traders note that macro hedge funds have continued to buy yen call options this week against a range of currencies, including the dollar, euro, and Swiss franc. That's according to Bloomberg. Elon Musk, when asked if he had plans to audit the Federal Reserve, said yes without offering any elaboration. He also added fuel to the possibility of giving payouts to the public from some of the budget savings that Doge has identified, something that with the GOP lawmakers are showing opposition to. I can see why, to be fair, because it'd be very inflationary. China's foreign ministry said Vice Premier will speak with US Treasury Secretary Peasant will communicate important issues in economic field between China and US over a video call. Sticking with China, the yuan hits a 3-month high on US trade deal optimism.
Oh, for God's sake, that's a headline straight out of 2018, that.
It is 90% done. We are so close to a 90% done headline, and I can't wait. That's what I'm here for.
Mnuchin will be back next.
Speaking of which, China's ramp-up in liquidity injections has failed to alleviate a squeeze in the money market, keeping borrowing costs elevated. The PBOC added that the largest single-day infusion so far in February on Friday, but repo rates remain elevated. The UK now needs to relax planning rules to ensure its choked electricity grid can cope with high demand and a massive build out of renewable power. That's according to a government advisor. German Conservative frontrunner Merz has pledged that a government under his leadership won't raise taxes to fund hundreds of billions of euros of investment needed in areas such as defence and infrastructure. So if he's not raising taxes, that means he's going to borrow. It's very simple. Argentinian President Milei prospects at legislative. I can't even say it. That word.
Legislative.
That's the one. Elections have been boosted after Argentina's Senate approved an electoral reform, even as cryptocurrency scandal raged around the libertarian leader. Some geopolitical news, although I suppose that is kind of fairly geopolitical. Ukrainian President Zelensky said his talks with US envoy Kellogg restore hope in terms of achieving an agreement with Washington. Secretary of State Rubio said a possible meeting between US President Trump and President Putin will largely depend on whether we can make any progress on ending the war in Ukraine. That's the quote. The EU wants to replace at least some of the fertilizer it imports from Russia with products processed from homegrown shit and piss. Not human, animals. Oh, also it says dung and urine, but I've paraphrased with shit and piss to reduce revenues of going to Moscow's war machine. That's gone to the FT. Chinese military vessels have held live fire exercises off the coast of Australia, with local media reporting commercial airlines being told to avoid the area. And just some equity names now. Japan is drawing up plans for Tesla to invest in the struggling car maker Nissan following the collapse of its merger talks with rival Honda. The group is hopeful Tesla will become a strategic investor since they believe Tesla is keen to acquire Nissan's plants in the US to help boost domestic manufacturing in response to Donald Trump's tariff threats. Rivian projected a surprise drop in EV deliveries for the year, but said it expected to post a modest gross profit as it slashed raw material and supply chain costs in its drive for efficiency. CATL, the big battery operation, will collaborate with Volkswagen on EV batteries, new materials, and other auto parts as the automaker seeks to adapt to the fast evolving and competitive EV market. Airbus has been downgraded by Jefferies to hold from buy due to challenges in production ramp up, integration of aerostructures business, and absence of a new share buyback to support shares in the next quarters. What else we got? Italy's antitrust agency said on Friday it was investigating BYD, Stellantis, Tesla, and Volkswagen for allegedly misleading consumers on the performance of their electric vehicles. And finally, from me,
Of course,
speaking of Nissan.
Sorry, I was going to say very quickly, Volkswagen have got previous with that, haven't they?
They very much have. Nissan Motors debt rating was cut to junk by Moody's. That's days after the Japanese automaker and peer Honda scrapped their planned merger. So one to keep an eye on, obviously, with the Tesla news as well. So I'm guessing if the Tesla story comes to nothing, that could put further pressure on Nissan. And that's it from me. Back to you in the studio.
Good stuff. Thank you, Ryan. In terms of today, then, we've already had some data out of the UK this morning. Pop the champagne, set the fireworks. Whoa. Hang on. Sorry. I've just seen that our good friend Zach Eisman is not doing his overnight news roundup next week.
Oh, what? You've not told me this.
Is he on holiday again?
Oh, he bloody... What?
Oh, dear.
I've just seen the tweet.
I know, that's what I saw.
Guys, if you pay peanuts, you get monkeys.
Well, the youth of today, you just can't rely on them. Disgraceful.
Name change to Judith Chalmers.
Anyway, what was I talking about?
That's a bit of a niche joke there, but the younger crowd won't be getting that one.
Someone's replied to it saying, well-deserved time off. He's never here.
Okay,
how can it be well-deserved? Oh, I don't know, some anonymous account. Anyway, let's move on. While you do that, I'll talk about the UK data that we've had this morning, with retail sales having been better than expected, rising by 1.7% on a month-on-month basis in January, rebounding from the 0.3% decline that we saw in December. Excluding fuel, sales rose by a whopping 2.1%, rebounding from the 0.6% decline that we saw over the festive period. Good data, but I don't think one retail sales print is enough for us to be saying that the UK economy is out of the woods. And in any case, we had the latest borrowing figures out of the UK this morning as well, which showed the deficit much wider than the OBR's forecast. Between April 2024 and January 2025, the UK budget deficit stood at £118.2 billion. The OBR had forecast for that to be at £105.4 billion, so just the 10% out, which for them isn't too bad. In terms of the remainder of the day, Yes, indeed. As we've alluded to, we have had PMIs out of France and Germany this morning. We have the Eurozone-wide figure due at the top of the hour. The manufacturing index expected at 47 from a prior 46.6. Services 51.5 from 51.3, and the composite gauge at 50.5 from 50.2. Of course, this is flash data for February. And then at 9:30 this morning, we have the UK flash PMIs due. The manufacturing gauge seen at 48.5 from a prior 48.3. Services and composite, they are both expected unchanged at 50.8 and 50.6 respectively. And of course, we also get the S&P PMIs out of the States at 2:45 this afternoon, although personally, I much prefer to look at the ISM metrics.
Just might be worth for listeners that aren't aware. So how the PMI works, when we say like flash prelims and finals, basically PMI data comes out in like three tiers, like three kind of stages. You get the flash reading, which is like the initial assessment, which is more kind of always with scope to be a little bit further out from estimates. And also when it comes to the prelim, which then is obviously more refined and obviously a small tweak. And then the final is normally not much in it. It's normally almost nearly bang on what's expected. So for trading, if anyone, for those traders out there that do trade headlines and figures, it's always the flash reading that gives the most volatility because it's the more of a guesswork.
It
Bit
is
colourful.
indeed. Very good. Thank you, Ryan. In terms of other bits and bobs that are on the docket today, it is an annoyingly busy US session, which no one wants on a Friday afternoon, to be completely honest with you. At 1:30, we have the December retail sales figures due out of Canada. Sales seen rising by 1.6% on the month compared to the stagnation seen in November. StatCan will also release a flash estimate, speaking of that, for the January data. And then at 3:00 this afternoon, we have the latest existing home sales figures out of the States, expected at 4.13 million in January from a prior 4.24 million. And we also have the final read on consumer sentiment for February from the University of Michigan. That index is expected unrevised at 67.8. The inflation expectations components might also attract some degree of attention, although recall that the figures are at the moment being horrifically skewed by political leaning. For some context on that, in the preliminary print, Republicans expected inflation to be at 0% over the next 12 months, and Democrats expected inflation to be at 5% over the next 12 months, which quite frankly makes a complete mockery of the data. In terms of other bits and bobs, we are due to hear from the ECB's Lane as well as the Fed's Jefferson, and I believe some calendars, yes, I'm looking at you, Reuters, have Kugler on the calendar from the Fed as well. No notable earnings due before the market open, but of course the other thing to be aware of as we move into the weekend is that there is a potential for gapping risk, not only around President Trump, but also around the German elections, which are taking place on Sunday. The exit polls from those German elections should drop at around about 5:00 Sunday evening, which is about an hour before the FX market gets up and running for the new trading week. I think markets will be focused primarily on two things when it comes to that German election, because consensus leans heavily towards the CDU/CSU forming the next coalition government. The first thing participants will be focusing on is how many parties are going to be required to form that government. Is it going to be a very simple grand coalition, two parties, away we go, or do more people need to get involved? And secondly, by extension of that, there is the question of how long it will take to form a government. Of course, if coalition negotiations do prove to be quite protracted, that will naturally be a headwind for European assets, and it comes at a pretty dismal time with the German economy stagnating. Trump threatening to slap tariffs on European goods, and of course also as these geopolitical negotiations go on without Europe having a seat at the table. And a bit of shameless self-promotion, I did quite a long write-up on the German elections on the Pepstone site if anyone wants to have a gander. And that is pretty much it from me this morning for today and for this week.
Wonderbar. Thank you, Mr. Michael Brown. Much
what language
appreciated.
was that?
I don't know. I think it was German, but I'm kind of guessing. Mate, thank you as always. Listeners, thank you so much for tuning in this week. Zach, thank you for your overnight news roundup. We will discuss your holiday schedule next week. And I guess if you are trading today, keep it tight. Whatever you're doing this weekend, have a lovely one. Stay safe. And we will see you bright and early on Monday. Take care.
Bye-bye.
Bye-bye.